Hello and a very warm welcome from Barangaroo Studios. I'm Amber Sherlock and this is The Call, 10 stocks picked by you, 2 experts, 1 hour. It is Monday, the 14th of November. First up today, our 2 experts. Joining us on today's show for the full hour, Mathan Somasundaram from Deep Data Analytics and Josh Barker from Macqro Capital. A big welcome to both of you this Monday.
Great.
It's great to have you both on the program. Let's get stuck in, shall we? And we're going to take a quick look at the first 5 stocks we're going to cover today as picked by you. The first one's Media, and then we're going to followed by Digital X, Hello World Travel, Ready Tech and Whitehaven Coal. So they're the top 5 viewer picks of the day. But first we're going to go to the stock of the day and we're going to take a look at Elders. Now shares are down around 15% today as their long-serving CEO Mark Allison announced his planned retirement, as well as the recent heavy rain causing a bit of uncertainty around the summer and winter crop harvest. That's despite a profit jump of 9% to $162 million in the 12 months to September 30. That's slightly lower than analysts' estimates of around $169 million. A successor is yet to be appointed to the CEO role, with the Elders board saying they've started a national and international search. Let's take a quick look at, that's still down around nearly 15% today. Mathan, what are your thoughts on Elders?
Look, we've been big fans. Look, the CEO is great. He's been there through the cycle. He's done probably one of the great turnaround stories. These are classic cyclical agri sector. It's volatile at the best of times. And he's actually built a pretty good stable model. And yes, it's probably the transition is quicker than what the market expected. I mean, the result was solid. I don't think that's a huge worry. It's more the fact that he's moving over. There's a big quant fund, in the second biggest shareholder is a quant fund. And yeah, when the quant funds decide to get out, they leave a trail of damage. So you have that advantage on your side. You want the discount for these kind of stocks because agri stock comes with the cyclical risk, and that's you're getting that now. So I think it's an interesting time. We've looked at this stock as probably 30-40% cheap at this point. I think market called the top in agri sector the last 3 out of the last 4 years, I think, and it's been wrong. So I'm more than happy to buy it with the discount. So we entered it around these levels, actually cheaper than this, but we're happy to sit through it because I think he's done the right thing. He's been there a long time. The operations are doing as well as they could be. He's given a 12 months time frame. It gives new management to come in, run it while it's doing well, and take off for the next cycle. So I think it's well placed. It's good valuation, and I think it's a diversified regional play, and the regional economy is doing well. So I'm happy to buy Elders.
All right, a buy for Mathan. Josh, what are your thoughts?
Yeah, largely agree. It's one that we've liked as well in the past. Just caught up a little bit in negative sentiment. One from Russia retreating from a significant part of the Ukraine, so grain prices are off a little bit, which it tends to track in the wheat price as well. So GrainCorp today is down 3%. So obviously the negative sentiment around the CEO transition, but it is a year away. He has been pretty pivotal to the business, but I don't think it's necessarily such a founder-led business. It's an agricultural company where they really benefit from having acquisitions that work well together. So a lot of small operations throughout the whole country and a lot of very diversified areas. So I don't think him leaving necessarily impacts the core of the business too much. It's interesting with the retreat from the Ukraine. It also does add to their bottom line a little bit. So it tends to track a lot of those wheat prices, but it's not a huge fundamental driver for the business. But it does alleviate a little bit of the costs around so fertilizers and things like that, some of the input costs. So I think it is actually better for their bottom line in the long term. But yeah, definitely negative sentiment. When you get these big drops, they can happen for a couple of days. Algos at play as well. So I think just let it settle for a couple of days. But I think in terms of a medium 1 year plus outlook, they're meant to have a really good second half. A really good first half of next year, and then the second half drops off a little bit, but I think is still in a really strong area.
As Mathan said, ag is cyclical, and I know we do have a lot of weather events in Australia, but particularly at the moment we've seen some huge floods and rain, and that's not worrying you in terms of negative sentiment and the output?
Well, it was interesting. They looked to combat that in their report, actually, where they showed all of their earnings increasing year on year, and they actually highlighted all of the adverse weather impacts and things like that had occurred. So it tends to outperform regardless of the situation, and I think did well when the bushfires were on. There's some drought and flooding issues, but when isn't there in Australia?
Yeah.
So they know how to handle
Just
it.
feel like it's particularly bad at the moment, but yes,
Yeah,
I agree
yeah.
with you.
I
All right.
think it does so well because for them, they don't really worry about where they're coming through at any particular time. They're diversified. It's
Yep.
really good. And the beauty of for them is the fact that their customers, the regional Australians, are willing to pay up. And so it's not really an issue for them to pass on the cost. So even though their costs have gone up, the profit's doing well because they're able to pass on. There's not a lot of businesses out there that have customers that are willing to pay higher prices.
No.
But these guys have that.
Okay, great. All right, well, let's take a look at these stocks as picked by you. Now, the first stock of the day is from Parker, and he wants to know about oOh!media. It's an Australian outdoor advertising and media company based in Sydney. It's one of Australia's largest operators of out-of-home advertising products. Mathan, what are your thoughts on oOh!media?
Yeah, look, we're a fan. We like the media sector because at the end of the day, if you're playing the reopening cycle, which has been reopening for so long, you need people to get back in. So we're seeing more and more people coming back into the cities, and retail is obviously struggling and they need to advertise more. So the whole media cycle for me looks interesting. And when the pullback happened, retail and media were the two sectors that got hammered for recession. So they pretty much got smashed down and they're recovering gradually. Now we've had updates from Channel 9, who's the biggest gorilla in the media sector. And again, things are improving, but they're improving gradually. Obviously with what's happening with interest rates, consumer sentiment and spending into Christmas is going to be a bit dicey. But overall, I think that forces more retailers to advertise, to be more competitive. So I think the media sector holds up well. It does carry a decent amount of debt. With rising cost of debt, that's going to hurt them. But overall, I think you're buying a discounted cyclical and you're betting on the cyclical recovering. And I think on a global basis, we are worried about a global recession, but Australia is probably more defensive than most Western economies. So it should hold up better. So in that context, I'm more than happy to play the domestic cyclicals, and oOh!media is a classic domestic cyclical. So I like it.
So is that a buy?
It's a buy.
Okay, what about you, Josh? Is it a buy from you too?
I think it's a hold, a bit of a short-term recovery with this one. So a lot of the travel-based locations, so they've got a lot of train stations and airports, which are getting out there and travelling a bit more. I think it's in, again, that Christmas spending is going to also help out their advertising and things like that, spending there. I think just as a longer-term play, doesn't yield too high. It's got a lot of debt, as Mathan mentioned. And the 5-year share price return on this one is down about 60%. It's actually below its listing price in 2015. So it's failed to deliver shareholder return over the long term. And I think, just some of those pressures are going to start to come through after the Christmas period and after the saturation of the travel plays out. So I think it's a hold for a short-term recovery. I'd try to look to get out of it at about $1.40, which is about 8% above where it was today.
Okay, so it's a buy from Mathan and a hold from Josh. Let's move on to our second stock of the day, and Kylie wants the expert's opinion on Digital X, which is an Australian blockchain investment company that designs and develops blockchain technology applications for business and enterprise organisations. And Mathan, what do you think of this one?
Wow, what a time. I mean, you want to look at blockchain, you don't look at it at the time when crypto world is in turmoil. It's interesting, I have to say, reading into all that's happening. There's obviously partial fraud, there's partial greed between the industry and the lack of regulation. There's a lot of risk involved. I love the technology. I mean, the blockchain technology, I think, holds. It's quite fascinatingly interesting. I mean, it's nothing new more than object-oriented programming. So most people who do programming would know that these kind of logic always existed. It's been packaged well, and the upside of that is quite interesting. And there's a lot of applications that can play out of it. But look, this is a very small micro cap. They're playing in a space that sentiment is going to be pretty tough over the next 6 to 12 months. I think the digital asset space, especially the crypto space, is going to see some serious pain as the flow and effects of what's happening. And I don't think that's over. I think that's going to play out for a while. There is way too many uncertainties. Now is not the time. But look, it's a space that I'm interested in because I expect a fair amount of pain to go through over the next 6 months. And whoever's standing on the other side, and if you've got the balance sheet and the cash flow to survive through, you're going to start benefiting from the cyclical upside that comes into technology change.
Down 80% in 1 year.
Yeah. So, you know, this is not the time to bet on the small guys in a sector that's getting under pressure. You just, you know, no need to be a hero here. You know, pick up a few stock lists that you like, read up on them, keep a tab on them, see how they do over the next 6 months, because it's going to be a systematic test for the sector. And what comes out on the other side, whoever's standing with the balance sheet, they'll be interesting.
So a sell?
Oh, look, right now I'd be going, well, you've taken the hit. It's taken such a big hit. I think the cash flow, the only worry about some of these things is they'll probably have to raise money.
Yeah.
And when you've been beaten up, the next raising will be such a discount. So, yeah, look, I've lost enough money in these kind of early stage plays to know that, yeah, you never say it can't go lower, it goes lower. So you probably should be taking the money out, seeing how the industry settles before you jump back in.
Okay, do you agree?
I couldn't agree more. Yeah, it's a sell. Speak of balance sheets, 80% of this company's balance sheets is held in cryptocurrencies.
That's the problem.
So, you know, what tangible, you know, value do you place on that? And also, they've been a company that's been around for a while. They started off in Bitcoin mining. They've had to diversify because that's no longer a unique thing. So what they've had to diversify into is providing liquidity for some platforms. You know, all the news articles lately around cryptocurrencies is that platforms and, you know, meant to be, you know, stable assets have been going down to zero, which obviously these guys are taking the other side and providing that liquidity for. So hugely risky area, and just the fact that their balance sheet is in something that can drop 20% in a day and will never be cheap because you don't know how far it could go down.
Yeah.
It's a sell for the time being.
Just a quick one. The cash burn,
Yep.
within the next 3 quarters, they will have to raise money.
Yeah.
So it's coming in the next 6 months. So you're going to get diluted.
Yep. So a double sell. Gosh, we've got a lot of sells today, don't we?
Well, I think it's the specky nature. I think people are trying to pick the turnaround.
Yeah.
But the speckier you go, the riskier it gets.
The riskier it
That's
gets.
the problem.
All right, well, let's take a look at our third stock of the day. In its Hello World Travel, David wants to know what our experts think of the travel distribution company. It's based here in Australia and provides international and domestic travel products and services to clients around the world. Mathan, what do you think of this one?
Yeah, this is, I like the travel industry simply because there's a number of them have massive shorts in them. You know that there's a catch-up being played out in the travel sector. We're going into a Christmas holiday and, you know, God, every time Australia has a Christmas holiday, there's a pandemic wave.
Oh, stop it.
And you know what? It's coming. But you know what? On the flip side, everyone's probably want to leave Australia.
Well, that's true too. So, although everyone will come back and bring something with them, won't they? So.
It's a gift that keeps giving.
Yep.
I think the travel does well. I mean, the numbers out of Qantas tells you people are traveling, and that's kept playing catch up. So the travel sector should do well. The margins are probably less. The only problem with Hello World is you look at the bigger players, they're giving you pretty much a similar kind of return.
Yep.
So my favorite is Flight Centre. I just love the shorts in it. It's a great trading stock. I'm not there in the travel sector for the long-term dynamics because it's too patchy. And so what I'm looking for is if it's a short-term trade, this would be the interesting one. I think Flight Centre has a decent amount of shorts and the numbers will be okay. I think that you buy this around the mid, around 14, 15 and you take profit anything above $20. So you get that trading range, it works beautifully. They've all issued a hell of a lot of shares to survive through the pandemic. So there's a fair amount of dilution which doesn't show properly on the share price. So the $20 Flight Centre is actually $40 pre-pandemic. So in a market
so the volatility of travel and the travel industry is not worrying you?
Well, as I said, it's a trading stock.
Yep.
For traders, I don't mind. But if you're a long-term investor, I think you look for assets that's going to hold up better and give you the same thematic. So for me, if I'm looking at a travel thematic, I'd look at Auckland International Airport. You get the travel thematic, you get the safety of New Zealand adding to it, and it's a property developer. So you get multiple ponies running for you,
Yep.
and it's a much stable play, and asset is a phenomenally good asset. So in that context, that's what I would look at for long-term investors, and you get a good yield. But if you're looking at a trading opportunity, I think that travel agents provide that, but I'd probably look at Flight Centre for the scale and the global play rather than Hello World.
So buy, hold or sell?
I don't think the risk is too much, and Qantas is selling out. I wouldn't be there. Hello World.
Okay. Josh, what do you think? Do you agree?
Definitely agree with the sentiment around the travel sector. We could probably talk all day about how good that is, and I think it's been pretty well spoken about over the last year, but it's still got a bit more to go. We saw that with updates from Qantas as well. The issue with Hello World, so you're kind of just wanting to pick the best out of that sector, and I think Hello World actually ranks pretty far behind in terms of its online presence. They're actually looking to expand into shop fronts, and I just think that the digital booking platforms, consumer behaviour is more skewed towards that way these days. So we definitely prefer Webjet as a long-term alternative. I think it's got a much better business model. It did issue a lot of shares, but not quite as much as some of the other ones. So I definitely think that's a stronger performer, and Mathan just very briefly touched on it at the end there, but the sell from Qantas. So Qantas moved out of its position of $1.72. I think that's going to be pretty large sign and significance there. They probably know something, or have a good idea. They definitely see value elsewhere. So I'd be taking the same approach as Qantas.
So if you have shares in Hello World Travel at the moment, what would you advise?
Oh, I'd sell it and put it into Webjet,
Okay.
Yeah.
Webjet here, Flight Centre here.
Yeah.
Maybe
both
not
of them
Hello.
are heavily shorted.
Yeah.
Both of them have issued a lot of shares to survive. Both of them are pretty good global models. So I think you do okay on both. It's a trading sector.
Yeah, okay. Let's move on to our fourth stock. And Frank wants to know about ReadyTech. Now, this is a software developer. They create technology for education, workforce management, local communities and government, just to name a few. Was in the news about 2 weeks ago with Pacific Equity pursuing a buyout of the company. Josh, what do you think of this one?
Yeah, I think the most important part to focus on is the buyout, just for the short term. As a general rule, we would say at least take half of your position or some of your position at the very least on that takeover offer. There's every chance that it gets pulled, and it was just on media speculation before it was an official announcement. So I definitely think the price that it got to on the back of that was definitely a good sell. You can see there it's right top of the range for the yearly, and I believe that goes back even further to be an all-time high for the stock. It's done quite well providing those education services on the back of COVID. There's also a bit of fear that a lot of that is going to start to get pulled back, but again, we're kind of waiting on some speculation around the whole job trainer and thing from local government. So a bit of a risk as to whether that support sticks in there for this company. So yeah, I'd advise sell/lighten half your position at the very least. And yeah, done quite well on the position, so to take profits at all-time high on the back of a takeover.
Okay, Josh, what do you think? I mean, it's Mathan, sorry, we've heard from Josh. Mathan?
Look, it's a sector that's at the moment in a M&A watch.
Yeah.
Pretty much every stock that's linked to that education sector is on an M&A play. If not, the media is willing to push it. So you've got to love that. They have been underperforming. You can see the government policies playing into it. And Josh was right. There's a definite boost that comes out of regulatory updates, but at the same time, that can take it away from you as well. So the governments are facing massive deficits. So these things can turn on you, whether it's health, whether it's social, whether it's education. The budget changes, they can be very tiny, and the industry suddenly can, some win, some lose.
Yeah.
So there's always risk attached to it. So this is not easy, and I think the takeover pretty much takes away a lot of your upside. I don't see a huge upside. Definitely agree with Josh in taking at least half off the table on any takeover. You just got to manage risk. This is a market where it's not for the heroes. So take at least half off the table. It's on a massive multiple. Yes, there's a cyclical recovery. The price is already assuming that. The takeover is already assuming that. So if the takeover disappears, this thing comes off quite hard. So you just got to be smart about it. I'd be tempted to take all your money and going somewhere else.
Okay.
But look, it's as good as it's going to get in the short term.
Yeah. How likely is this takeover?
Yeah, it's a takeover.
Yeah.
Your downside risk is that goes and then you're stuck there waiting for the recovery. So, you've done well for the right or wrong reason. Go somewhere else.
Okay, so it's a sell from both of you. In agreement. All right, let's move on to our fifth stock of the day. And it's the Australian coal mining company, Whitehaven Coal, and it's from one of our viewers, Mia. Now, Whitehaven shares dropped on Friday with concerns that the booming coal prices could attract additional taxes. Obviously, if this happened, it would likely lead to lower than forecast earnings and dividends, but there's no guarantee these taxes will actually be introduced. But of course, there is a lot of speculation about it. Josh, what do you think of Whitehaven Coal?
Yeah, well, perhaps Mia was watching me on the last call on Friday when
Yeah.
I was saying it was a good opportunity in the market at the moment. So I think just the fact that they've come out with that buyback, 25% of the company is going to be bought back over the next 12 months. It's going to create some general support at the very least, and it really does largely depend on your views on coals. Japan's come out, which is actually makes up about 50% of Whitehaven's revenue, with a ban on Russian coal. We're entering into the European winter. There's a lot of risks with that. Whether Putin uses that as his final war chest, and it seems to be giving up ground now. So that's definitely a huge risk, and I think it's only going to be exacerbated in the winter. So I do think that coal prices remain fairly high, in which case, similar to Elders, it's going to make really good earnings. It's going to do the share buyback, have the ability to do that. It's got a very healthy balance sheet. It's going to pay dividends. So I think, it's definitely a buy from our point of view at these levels.
Mathan, would you say a buy for Whitehaven Coal?
Oh, that's a tough one. We've spoken about this numerous times.
Yeah.
My view is you're playing the energy thematic, right? There's short supply in almost everything. You had the EVs and the coals lead the run, and then you had the LNGs catch up, and then the oil. We've been diversifying. That's our strategy. We got out of coal recently. I mean, the last couple of months, we've been telling everyone to get out of coal and move into the oil plays, move into LNG plays, move into uranium for the specky side.
Yeah.
Because the reality is the energy thematic holds. Coal, you knew this was coming. It's politically just great to say, super profit tax. So that was always coming. And then you got the weather issues that'll dampen production. That was a short-term issue as well. The buybacks, I think mostly everyone kind of expected that was going to play out. So the dynamics for me with coal is, I don't think new supply is going to suddenly come in, but the demand will exist. Now the question would be, how much will the oil, the energy prices hold up? I think coal has done so well, it's coming off. It's still going to be high, but I don't know if the market's going to be that excited chasing it now. So we've been getting out of coal, moving into oil, which is Karoon for us. For uranium specky side, we've been in Boss Energy, and on the LNG side, being Woodside. So I think the thematic for the sector plays well. I think when you're playing purely coal, in even EVs or that ran ahead of coal. So for me, chasing EV or coal at this point in the cycle, you're late to the cycle. So I'd rather go to the guys who have underperformed, are playing catch up, rather than the guys who've already left.
So if you have stock in Whitehaven Coal,
we've been saying to sell gradually and move into other energy plays, and I don't see the reason why that should change.
All right.
I definitely agree with the energy basket. We've been doing that a lot this year, and we probably will continue to do that. The different energy sources will go through periods of positive sentiment, and when they come back into favour, both fundamentally as well. So we definitely have a basket. Don't just depend on one energy source. That's for sure. Have that basket. Play the ranges. Play the ones that are undervalued. Take profits when it does move considerably higher in the short term as well. But definitely have a decent exposure to the energy play. I think it's really going to be a strong one for the next period too.
All right, well, before we get to our next stocks, let's take a quick review of our stock of the day and our first viewer pick stock. So I'm going to have a look at my notes here, and we of course did Elders as our stock of the day, and it was a buy from Mathan with a discount, and for Josh it was a buy. It's caught up in a bit of negative sentiment, but it's still a good buy. If we move on to our first stock of the day, as chosen by you, which of course was EU Media, Nathan said buy. Retail is struggling, they need to advertise, but he likes the media sector, while Josh says it's a hold. It has a lot of debt, it is below its listing price. So a bit of difference in opinion there. A buy from Mathan and a hold from Josh on Media. If we move on to our next one, Digital X, Mathan says sell. Sentiment's going to be tough over the next 6 to 12 months. Too many uncertainties, not the time to bet on the small guys. Josh also says sell. 80% of the company's balance sheet is in crypto. Moving on to our third viewer, stock of the day, which is Hello World Travel. Mathan says sell. He likes the travel industry, prefers Flight Centre, not in the travel sector for the long term, so wouldn't buy this particular stock. Josh also says sell, prefers Webjet. So it's a sell from both of them. Mathan preferring Flight Centre and Josh preferring Webjet to Hello World Travel. If we move on to ReadyTech, Mathan says a good sell, at least probably half your position on the back of the takeover announcement. And Josh says on an M&A watch, they have been underperforming. Sell, also take at least half off the table for ReadyTech. So it is a sell from Mathan and Josh, at least half for the moment. And finally, Whitehaven Coal, Mathan says sell, him gradually getting out of coal, moving into other energy. Josh says a buy. The buyback will create some general support. So a sell from Mathan and a buy from Josh on Whitehaven Coal. So they were our top 5 stocks for the day, our first 5. And the call is also tracking our very own high conviction fund, which is picked by our investment committee. The latest episode of the committee meeting is live for you to watch at ausbiz.com. So let's check in with that portfolio update. Going into November, Incitec Pivot was removed. 7 Group Holdings was added to the portfolio and Mineral Resources was trimmed. JB Hi-Fi and Wesfarmers weightings were also increased. Let's see how the portfolio is performing. So our fund is up 9.25% on a cumulative return basis since inception on March the 1st. So keep sending in your requests and keep the calls switched on to see which stocks our committee will be looking at next. I hope you enjoyed the show so far. It is now time to look at our next 5 stocks as picked by our viewers. And we're going to take a look at Computershare, followed by Charter Hall Retail REIT, Sims, Orica and REA Group. So of course, first on that is Computershare, our 6th stock. It's picked by Pete. It's an Australian stock transfers company that provides corporate trust, stock transfer and employee share plan services in a number of different countries. Mathan, what do you think of Computershare?
This is a stock that you would have not looked at 2 years ago and said, now this is going to outperform. This is boring. I mean, this is as boring as it gets, but it's actually absolutely smashed it. The boring stocks have done well. I mean, you know, when private equity is trying to buy airports and roads and willing to pay premium, things are a bit out of whack. Computershare has absolutely killed it. It benefits from the yield, rising yield environment. This is not something that you sit there and go, it's a high growth story. This is boring growth story, but it's done really well. But I guess there's always a limit to how much you're willing to pay for that. And over the last 6 months, it's pretty much gone sideways. I think it's doing well. Is the future going to be as good? I think it'll struggle. It's what it needs to be to do the next level. I struggle to see how the growth can come through. The multiple is high. Its yield is not as good anymore given where the interest rates are. So I don't know what you're buying it for. I think the risk is if they start to underperform, this thing comes off.
Yep.
Now, benefits from massive IPO cycle that's gone through. I suspect over the next year, the IPO cycle will slow down. I know every broker will tell you that it's going up, but I don't think it can be sustained in a market where multiples are high. So in that environment, I think Computershare struggles. Look, you've done really well. If you've been in that stock, amazing. Most people did not pick this, but it's been a great performer. Don't get greedy. Start taking money off the table. I'd be taking profit on this one. You've done well, and yeah, wow. It is not one that I'd say 9 out of 10 people would have picked 2 years ago. But
just because it was boring.
It was boring, and there was no growth story. And who would have thought something with very little growth story is going to have a high multiple at the end of it? But that's the market we're in.
Okay, Josh, what do you think?
Well, I think the analyst team over at Macqro are doing something right because they did put out a recommendation on CPU about a year ago. And they're still really positive on it. So the recent upgrade and guidance came with a 53% increase in net income and earnings per share set to increase by about 90%. So they're really benefiting from the strong exchange rate. They hold their money in US, they report in US. So that's getting about $1.55 over that period. And whilst we're at nearing the end of the rate hike cycle in the US, there's still meant to be another couple of tick ups before they look to just hold it for the time being. So they're still going to be benefiting from the interest that they earn when dividends are paid out. Also, when any capital raises come through, they'll benefit from that. But yeah, I do agree that the mergers and acquisitions, we'll start to see some IPOs will start to slow down, which they have already. And the fact that this company has held up for quite some time, shows that they're willing to weather that part of the market. So I think if that starts to get back and interest rates are still high, the US dollar is still high, then it can definitely continue to get on with the job. I'd hold for the time being. That recent breakout to a new high and consolidating at new high levels is a very strong technical indicator. So I'd be okay to hold for the time being, but yeah, definitely monitor to take in profits.
Okay, a little bit of disagreement, a hold from Josh and a sell from Mathan. All right, let's take a look at our next stock, which is Charter Hall Retail REIT. It's an Australian-listed property trust offering exposure primarily to the supermarket anchored neighbourhood and sub-regional shopping centre markets in Australia. Josh, let's go back to you on this one. What are your thoughts?
Great boring company, as Nathan loves. So,
two in a row.
Looking at in terms of some of the components they're doing, it's viewed as a very defensive REIT. Some of its major ties are to the strong supermarket chains. So, top 10 customers: Coles, Woolworths, BP, Wesfarmers. They're obviously going to continue to pay their rents, of course. So the earnings are going to be quite consistent with this one. I think Charter Hall has got a pretty good track record. We spoke about their significance today with elders of, managing directors and CEOs. David Harrison's been at the helm from the company being $500 million to now 80 billion. So he's done a lot of work there. He's not leaving anytime soon, hopefully. So, I think it's just been a really strong sector. Obviously, that's kind of where you want to be in the non-cyclicals as well, as we, go through a little bit of pain on the economic front. That being said, household savings are still at a decent level despite coming off a little bit. So in 2021, they were about 11.7%, and now they're about 8.7%, which is just coming off those highs realistically. Consumers are preparing for higher cost inputs. I think they're going to still continue to have those spending at all these places where Charter Hall owns the properties for. So I think this one I have a buy on actually.
A buy? Yeah. Okay.
For your REIT exposure. I think REITs got some positive sentiment around
What
them
are some of those
recently.
companies you mentioned that it has?
So its biggest holding, or its biggest tenant, is Coles, which makes up about 16%. Woolworths is 15%.
And it doesn't, the cost of living and price increases and all that sort of pressures, you don't think is going to be anything of a worry?
Well, I think they're still going to have to go to those sort of areas. So, maybe they don't shop as much at Myer and things like that, but they still spend the same at Coles and still frequenting those areas. Some of their other ones, Aldi, Specsavers, things that people aren't going to change their spending habits too drastically on, and hence the nature of these non-discretionary areas. So whilst it does say retail in the company name, it's a little bit different retail. It's that non-cyclical retail, which we actually think is going to be a lot more stable for the next period anyway.
Mathan, do you agree?
It depends on what you're after. So if you're a yield thematic investor, you're going to have a certain exposure into property. I'm not a fan of the property sector. Whenever you have a recession cycle, I always say turn around and run. And because it's a bit like the travel industry through the pandemic, when you get into that down cycle, because they do carry a fair amount of debt, they will have to issue shares and then you get diluted down. The only sector that went down during the GFC and never recovered to the pre-GFC level is property trust. So there's a lessons we have learned through the cycle. I think it's a very good play, and the major renters, they're the anchor players, right? The Coles, the Woolies, they're anchor players. So they've got long-term contracts, they're locked in. I think the business holds up quite well. Interestingly, I spoke to a lot of small business guys in the city, and you find out a lot of them have not paid rent in a very long time.
Wow, okay.
So there's a lot of IOUs sitting there. But the anchor players do not want empty stores. So the small stores get the benefit of still functioning without paying rent till someone comes for that space.
Okay, because that was my point. I was sort of, with this economic climate at the moment, you'd think they would be having maybe less stores or...
Yeah, so they let those people sit there because they don't want empty stores.
Okay.
But until someone turns up. Now, I think there will be a time when you'll see some downgrades come through, but there will be the smaller players. So I don't think it's going to be a huge part of their earnings because the anchor players are going to be there. They're much more diversified and they're stable. So I don't think it's a huge issue, but the flip side of that is these are geared, very highly geared. All defensives are highly geared. So rising cost of debt means there's pressures coming. So in that context, there will be an issue. In the yield thematic, this is not one that gives you franking. So again, that's a negative for that. So you have to look at what you're there for. Look, I think they're stable. I think they're solid. They're diversified. I don't think they're going to blow up anytime soon. It doesn't excite me. But for me, I would probably put it as a hold because you're there for the yield play, and I still think it's solid and it'll hold up. It'll probably come lower with the economic cycle, but it'll recover, so it's okay in the long term. But if you're going to pick 10 to 15 stocks, it just doesn't excite me to be there. I don't think the cycle helps them.
What excites you?
Well, I think in this kind of environment, you want something in a value territory with the cycle. Everything has a cycle. Even the defensives have a cycle, just longer cycle. So if I'm looking for things with cycles recovering, for me, the food thematic still plays well. Energy thematic plays well. And then you look at things like gold plays well because it's the cheapest miners in the market. And you can see with the US dollar coming off, gold is running hard. So those kind of thematics play well and for the cycle that you're in. So for me, I'm looking at the things that are starting their cycle, not at the end of it. So most of the defensives over the last 2 years, everyone's gone in. And so they're the crowded trades, and property trust is part of that. Everyone's done well. Everyone's basically reassessed their valuations at the highest level. So going into the next couple of years, I don't think property prices are going to be that high. Even commercial property, which everyone loves. Now, as the demand comes off, valuations will come off, and that'll weigh on the market. So I think you're there, but if you're a long-term investor, you're not worried about that. You're sitting there going, can these guys hold their yield? I think there will be some weakness, but I think this is diversified and big enough that it'll hold it. But I'm not, on a total return basis, I don't think this will do well in the next couple of years.
Josh, do you agree with what Mathan was saying?
I like to have a diversified portfolio, and some of that will include an allocation to a real estate trust. So I think if you want a REIT, because a REIT, it promises exactly what it delivers. So if you want a REIT, I think that's a good one. But if you're after more growth, then you don't need to have a REIT in the portfolio necessarily. So.
Okay, well, let's move on to our 8th stock of the day. It's being requested by Anton, and he's asked the expert's opinion on Sims. Now, it's a global leader in metal and electronics recycling and an emerging leader in the renewable energy industry. Josh, what are your thoughts on Sims?
Yeah, this one's a really tough one for me. There's definitely really good arguments for and against this one. So, the price is off quite a bit. The steel price has fallen about 20% from July to now. There are expectations that steel production will be lower for the rest of the year and into next year. European steel production cuts have come through because it's just too expensive to power them with the gas prices. And it was in such a good upgrade cycle just prior to this recent movement, as you can see there on the chart. They had an update which shot through a key level being that $12 mark. And that comes up as a technical break and a sell. And then, today you've got BHP up like 5 or 6%, with Fortescue up nearly double digits today on the back of the view towards that. So, they're going to move hand in hand. I just think for this one, whilst it seems good, I still would have it as a sell. We'll see how it behaves around this, sort of mark. But if it gives it up at any stage, I think, you should sell. Just on the story not adding up a little bit and so many uncertainties. So, like Mathan said, if you've got a stock portfolio of 15 to 20 stocks, it probably doesn't crack the top 30. But it's just outside it. So, unfortunately, move out of it for the time being and just wait for a few of those things to clear up and the outlook be a bit more clearer for this one. Okay,
Josh says a sell for Sims. Mathan, what do you think?
Yeah, the steel sector is definitely one that's shocked a lot of people. I mean, it's had a huge run up, and obviously China plays a massive play in this. As Josh said, European players, costs are hurting them. Chinese steel producers are basically losing money. So the demand is likely to be weak, and there's, you get the story every couple of weeks that China is going to try and support their property sector, and it comes out like clockwork, and I think there's another one out this weekend.
Okay.
The sector is in trouble, but China intentionally wants to deflate the bubble. They want to not have speculators pushing up property prices. They want it to work organically. That doesn't work anywhere, but anyway, let's see how that plays out. But BlueScope is the best out of the two. Sims Metal is like your, the drunk cousin that turns up to your Christmas party. And nobody wants to touch it when BlueScope takes off, and then everyone goes, I wonder what Sims doing. And then Sims follows.
Okay.
And I always look at Sims and say, whenever it goes to single digit, it'll look ugly. That's the time to buy it.
Yep.
This is an ugly buy. You never buy this thing when it's looking good. And at the moment, BlueScope and Sims are sliding. That tells you what's happening in the sector. I'm not jumping in, but I am definitely keeping an eye on both of them. Iron ore has come off dramatically.
Yep.
Coal is coming off as well. So the input costs for steel players are coming down. So that's a positive. China is the big story. If China starts to stabilize and recover, right now they're expanding lockdowns. I mean, that's not the time property is going to do well. So when things start to improve in China, reopen, property cycle starts to pick up, then you want to be in this cycle. So again, these guys are classic cyclicals, and your upside is massive when the cycle runs, but the cycle is against you at the moment, so don't jump in, but definitely keep an eye on it. Sims looks ugly, but it's actually an okay model. BlueScope is a great model, so I would keep an eye on both of them, and when that cycle turns, you want to be there.
You're saying don't buy, but would you sell if you're in?
Look, if you're there, you've taken a fair hit and you understand it's cyclical. If you didn't, I'll smack you on the head. So if you know that it's a cyclical, you've taken the hit, I think you're willing to ride through it. I don't see both Sims and BlueScope as candidates that go bust. So I'm happy to sit through it. So if you've taken the hit, it's a good enough business that I would sit in it. Maybe if you want to manage risk, take some portion off the table. And when things improve, put that money back in so you average down your risk return. But yeah, it's a sector I want to be long, but it's not right now. So I'm waiting.
Okay. All right, let's move on to stock 9, which is from Simon, and it's Orica, of course, one of the largest providers of commercial explosives and blasting systems to the mining, quarrying, oil and gas construction markets. Josh, what are your thoughts on Orica?
I think it's a really good business. It's kind of mid-range at the moment, approaching not too far off the highs if it has one other little tick up. But yeah, definitely its revenue streams are quite strong, really diversified, with one of their biggest contributors being copper. So we're actually liking copper in the short term after the pretty decent sell-off that it's had. So I think that bodes well for them. I definitely look to hold this as it approaches those highs. Again, you probably want to reassess if it does get close to an all-time high. You'd be almost silly not to take profits on that. Mm-hmm. But yeah, it is a company that's been doing well. It has also been troubled by the higher gas spot price being like $20 or $30 per kilojoule. So it is getting hurt by that a little bit in terms of its key inputs. So something to keep aware of. It really depends. If you want to take the bet on energy prices going up or energy prices going down, this is one that's going to act inverse to that almost. So I think, yeah, given just the general strong demand for commodities still, it's a hold. I think there's a few other better ones that you could get a similar exposure with a few other alternatives in it. So I actually like IPL, Instatech Pivot, if you're after that explosive exposure. It's also got the fertilizer aspect to it. And then also, just in terms of its mining solutions, if you're quite positive on the other commodities, something like a mineral resources might be a better alternative for its mining solutions. Obviously, you take up a big exposure in iron ore and lithium with that company, but I think its mining solutions and mining aspects of its business are actually a lot better. Whereas you're also, it's just a little bit of a trade-off between what other commodities do you want. I think this is it just has the one play. I definitely wouldn't put it in my top 20, but I think it's good to hold until it gets back up to those recent highs, just given the positive sentiment, especially from today's movement in a lot of those iron ore miners, as well as our short-term view on copper as well.
All right, a hold from Josh on Orica. What are your thoughts, Mathan?
Oh, look, I could throw so many punts at this stock. It's definitely an explosive. Look, I think it's, Josh is right. I mean, Incitec Pivot, we like the whole chemical sector. They all offer a different a different horse for the race. In the context that you've got New Farm, seed technology, and then you've got Incitec Pivot, fertilizer, and it's got an explosive side, and they're looking to diversify that. They're trying to split it and sell it off, or potentially float it. So that's again a positive. Orica's, look, there's not a lot of top mega caps, the big caps, that are trading at a discount like Orica is. And so it always interests me when big caps are trading at a discount. Pre-pandemic, this was, mid $20. So there's a decent pullback from that level. Has it delivered? Mining services haven't. All mining services have been smashed, and Orica has been part of that. The big recovery story is the remote controlled explosives. That's what they're working on, and that could change the dynamics. This is a dominant global player. Granted, it's blowing stuff up, but still, it's a dominant global player. So it doesn't get the benefit of what it is. It's an amazing business. I thought someone like Wesfarmers, who's sitting with a $10 billion checkbook, might take them out because they have a history of managing underperforming big caps and also a history of managing chemical sector. So it could work for them. There are a list of private equity, if not anything else. But look, I think Orica has underperformed. It is one where it hasn't done much, where we've had almost every sector run. So it is one that I'm interested in. I think it's unique enough. It is a dominant player in the world. And I think what they're doing with the remote explosives can be a turnaround. The last update was positive. I want to be positive. I like the sector. I think it's one where I'm willing to take the punt because your downside risk is limited. It's pretty much gone sideways for the last couple of years, and they're executing relatively well. Mining services is actually improving. The capex numbers from the big miners are improving because they're selling well, they're getting good prices, they're willing to now punch holes in the ground and blow stuff up. And welcome to blowing stuff up. So I think Orica is going into a better outlook, and they should do better. I like the management. They've held it together through tough times. So I'd back them. You want to back a big cap on a turnaround story? I think Orica is one of them. So it looks ugly, they haven't done much, but I'd back them. I would put a buy on it simply because I think it's unique enough, it's global enough, and I think the high costs that are coming through, that market already knows about. So the trick here is if they can deliver through that, and I think they're beginning to, the last update shows that they're beginning to do well and the outlook is starting to improve, this could do quite well, and I think it's way undervalued for what it is. I mean, we buy stuff that don't make profits at 50, 60 or 500 PE. This thing actually has a business, a global business, and a unique business that should benefit from the recovery in the mining sector. And I think in a reflation cycle, commodity prices are high, miners should do well. This should do better. So I think it's worthwhile taking a punt. This is one I would back for a turnaround story.
Okay. We will keep our eyes and ears peeled for Orica. It is a buy from Mathan and a hold from Josh. All right, finally today, Paul wants to know about REA Group. It's a global online real estate advertising company. It's headquartered in Melbourne. It has offices in Hong Kong and India as well. Josh, what's your take on this one?
Yeah, very strong business. Really got the benefit of the housing market over the last couple of years. But that being said, it's still got pretty much a monopoly in the area. Definitely pretty much consensus that it's the better of the two in the area. So yeah, I think it's a little bit early on this one just at this stage. They make a lot of their money from advertising, as well as, it's very linked to how much activity is going on with the housing market, which we know has been, not great, but it does depend on your views towards that. I'm starting to get some people a lot more positive on the outlook there. But regardless, a big part of that is rental properties. There's actually the lowest level of rental properties on the market in 20 odd years at the moment, due to, obviously the interest rates not making it as attractive to rent it out, but also just the general reopen, international students coming back, workers coming back. So yeah, without the advertisement of new rentals, then it's not going to get as many visits. The visit numbers are definitely low, still 120 million per month, so they're definitely getting a lot of traffic nevertheless. But it's one that had a really good run, trading on really high PEs as well when it did have a good run. So I think it's a good business, and I think it's one you can keep on your radar. But I just think it's a little bit too early at this stage. Technically speaking, it's still in a downtrend, and until that dissipates, then you can see if the fundamentals are starting to add up on this one. Just for the time being, I don't think it's one that you really want to be exposed to at the moment, but definitely a good long-term business regardless.
So a sell at the moment?
Hold.
A hold.
Yeah, hold. I think because it's such a good business, you wouldn't want to sell it on a dip.
Yeah.
You know, you've probably taken the pain already after hopefully what's been a good run. Continue to hold through the sort of rough property cycle that we're having, because we know it's not going to last too long. I'm hearing from some people in the property markets that the next 5 years is going to be really strong. There's a large undersupply of housing in the market right now. So I think once that dissipates, once people get comfortable with higher interest rates as well, and comfortable with not selling at such a great price to what they were thinking they were going to get on paper, that'll start to normalise. I think in the property market, and especially transactions, if we're talking transactions, it's just starting to normalise. That's all that's happening. It went through a ridiculous period. It's going through a bit of a slowdown, and it'll just normalise. And Aussies love buying and selling property. So if that's what you're passionate about and what you believe in is going to continue, these guys are going to benefit, and they're the number one player in that space at the moment.
Mathan, Josh says a hold for the moment. What do you think?
REA is an amazing business. It's probably top 10 in Australia. Management and the business model, it's amazing. It helps to have an economy with a central bank that pumps property, so it kind of helps. REA is done, it's a global business, done really well, has multiple levers to play. Property bubble is global. It's happening everywhere, and it's coming off everywhere. I think it'll take time. It'll go through the cycle, and it'll have a bit of a cycle. The money that they earn most of their money from property developers, because they've got more amount of property on the side, and they hang around for a lot longer. So what's happening in property developer space is going to be critical to them, and I think that's tough. You're seeing a lot of them, the smaller ones, crumbling around the edges, and that's what you see early in the cycle, and that's what's happening. You can see there's panic station on property market, and the property has pulled back 10% at best, and we're talking about it went 20+% in the last 12 months. So it hasn't even given back 1 year's return, and already people are screaming blue murder. This tells you the culture in Australia. So does it matter? I don't think it matters. I think RBA has pretty much said we're going to back the property over the economy, and still doesn't matter, because what happens globally matters for interest rates. Interest rates are going to remain elevated for a lot longer than what people think. RBA has been wrong for a number of years, and I think they'll be wrong for a few more. REA here, I think the market is priced it well. So the pullback has been substantial. This is the old tech. So you've got REA, Seek, car sales. All three have had similar pullbacks. All three have bottomed and starting to build. And I think they're interesting because everyone wants to buy the next hot thing. This is old hot thing, but this is a solid old hot thing. So this is built into the economic cycle. It'll grind back with the economy. I think you buy it, but you're not going to do well in the next 6 to 12 months. You're going to struggle. I think over time, it will grind its way back up. It is so good that I'd never want to put a sell on it. Every quant fund has tried to short it for over a decade, got it wrong. And when it actually fell, nobody shorted it. Go figure. So it is one where I think you buy the pullback, but I think you've got to look at it over a 2 to 3 year time frame. I think it struggles. So if you're thinking of you want to get the return over the next 12 months, this is probably not the stock for you.
Yeah.
But geez, it is so damn good. So there's a time to buy it over the next year. But you might just look at it and say, I'll buy some now and spread it over the next 12 months, and you'll get the return in 12 to 18 months. But this is a very good business model, probably in the top 10. But I think it'll take a bit of time because RBA is doing death by 1,000 cuts for the property market.
Pretty scathing of the RBA there.
Oh, don't get me started. They were late to the game, then they were shocked by the game, and now they're saying they are actually going to pause. They're not going to raise in December. They're actually not going to raise at all in December, at a time when inflation in Australia is actually going to surpass US. They're forecasting on their own numbers, it's forecasted to go above them. So you're not actually raising rates so nobody cares when inflation is hitting the middle to low income, but everyone cares when property prices come off 5%. So don't get me started there. But look, I think RBA, I don't worry about RBA because they're price takers. What happens at the Fed matters. They're a global player. REA is a great business model, but globally, even countries who've never worried about property, especially in Europe, they're sitting in massive property bubbles. Look at some of the countries in Europe and you see, like I've got relatives in Germany, they never talk about property. Property prices in Germany has gone boom. They're like,
really?
Yeah, everywhere. I mean, countries that never talk about property as an investment, they've all gone whooshka. And so you sit there and go, what? That's what happens when you put zero rates around the world. Because you want the security, you want stability. So that bubble will take time to unwind. So I think this will take time, but geez, REA is an amazing model. I can't be negative on it simply because it's amazing.
You are definitely not being negative on it. Don't you worry about that. All right, let's take a quick review of those last 5 stocks we've just talked about. Our computer share, we had Josh said a hold benefiting from a strong exchange rate. Mathan said start to sell. It's a very boring stock, but it's absolutely killed it. Doesn't know if it can maintain momentum. Then we looked at Charter Hall Retail REIT. Josh said the buy, a good boring company, a really good strong sector. Mathan says a hold there for the yield play. Not a fan of the property sector, no franking, but they're stable and diversified. Moving on to Sims, Josh would still have it as a sell, just on the story. Good arguments for and against it. Mathan says don't buy, but if you're in and you're taking the hit, hold or maybe take some off the table. It's had a huge run up. BlueScope is the best. It's time to buy when it's in the single digits. Orica, Josh said a hold, reassess if it reaches an all-time high. Good business, strong demand for commodities, likes IPL, Incitec Pivot, not in his top 20. While Mathan says a buy, willing to take a punt. It hasn't done much. He's interested in it. It's unique. The last update was positive. It's way undervalued. And then finally, the REA Group, Josh says hold, a really strong business. Keep it on your radar. It's a little bit early. Mathan says a buy, very enthusiastic about this stock. It's a long-term one though, amazing business. They make most of their money from property developers, but definitely very, very enthusiastic about REA Group today. It has been a fantastic conversation. That is our show for today. Big thank you to Mathan from Deep Data Analytics and Joshua from Macqro Capital. Any stocks you'd like to cover, please flick us an email. The call at ausbiz.com.au or tweet to us at ausbiz TV. And just a reminder where to find all the stocks we have in the calls portfolio. You can head to ausbiz.co/portfolio. I'll be right back after this with the small caps. Thanks for watching.